work it all out, which ones would you cover, literally there is a mechanism already that are two very little tinkering numbers and a relief removed, and they have the mechanism already. So, you know, it's just sort of there just to, sorry to frighten everybody again, but I just think it's worth knowing. So again, okay, I've shown you what your tax position is sort of going into the company. I've shown you your sort of tax position that goes on every year being in the company. Well, okay, the next thing that you need to understand is the tax position if you ever want to sell some properties or get out. Okay, so if you sell some properties when they are in the limited company, you are going to pay corporation tax on those property sales. Okay, so they're in the company now, so there's no CGT payable, capital gains tax payable, it's corporation tax that is payable on the difference between the value that the property went in at and the value that the property you sold it at, assuming you haven't done any other additional works through the lifetime that are capital in nature. Yeah? Okay? Then you've got capital gains tax on the disposal of the shares in the company. So this comes back to what I was talking about with the carrying value. Yeah, this is where if you decide to dispose of your shares, all or some, that is a disposal for capital gains tax purposes, and therefore you potentially have some tax to pay. And the final one is the IHT on the value of the shares when you die. Okay, so you know, you've got two things. You're either going to sell the shares in your lifetime and pay capital gains tax, or you're not, but you'll have inheritance tax to pay. Or your estate will have inheritance tax to pay. So, dealing with corporation tax first. Payable on any sale of the property within the company, and again, same rates. You know, it's currently 19%. We'll be dropping to 17%, but it is less than what you would be paying personally. So if you owned these properties personally still, you would be paying 18% if you were a basic rate taxpayer, or 28% if you were a higher rate taxpayer. The issue being that although you pay less tax on the gain of the property, you're going to pay more tax to get the money out of the company. Paul covered this. Yeah? So you can extract the proceeds from the company by way of a dividend, but you are then going to pay some further tax. And this comes back down to, again, so in practical terms, I would be saying to people, listen, if your plan is at some point you want to sell these properties in the not too distant future, there could be a good reason still to incorporate, unless you're like Hobie, where you wanted to have all the proceeds in your own pocket and spend them, and you be in control of that, then that you do not want to be incorporated. If you've got a load of properties with gains in them, and you incorporate them into your property company, if you then sell them, you pay corporation tax on the gain, the money is in the company, well, you can get that out slowly over time. You could be paying bloody great big pension contributions, and pensions are outside of your estate for inheritance tax purposes. So there are trade-offs and advantages and negatives of all of this. So it's understanding what's the bigger picture for you. Okay? So that's corporation tax payable on any sales of property in the company. Like I said, what you might do is you might decide I'm getting out of HMOs, but I still want to be in property. So you can incorporate, sell the properties, pay the corporation tax. You've got a load of cash sitting in the company. I'm now going to go and buy a load of commercial property or something else. Yeah. So you know, it's only if you want to get the money out and spend it that these big tax issues occur. You may then decide that that company that's got all this cash sitting in it is now an investment company, and you turn around and do other things with it. So very quickly, another example. So you want to exit your portfolio. You've got your 5 HMOs at 750,000. They've grown in value now, as you can see. Okay, so they've increased from the 450 from when you incorporated them. So it's many years hence. They're now worth 750,000 each. Okay, so when you put them into the company at 450, that was the base cost of that property. Yeah, you've still got the 5 mortgages because they were interest-only mortgages. That hasn't changed. So the corporation tax you will pay is the value that you sold it at, less the value that you put them in at, gives you the gain, 17% corporation tax to pay. This is assuming it's next year. You've got a corporation tax bill of 255,000 to pay in the company. So you've got then, if you wanted to then, so you've turned the properties into cash, yeah. You've then turned around and taken off the mortgage, paid back the mortgages. pay the tax, you've got £1.995 million worth of net proceeds sitting in cash in the company. What do you do? And this is what I say, this comes down to what do you want to do? Do you want to extract it? If you want to extract it, there's another layer of tax. If you want to reinvest it, it's cash there to go and reinvest. So the next tax that will potentially hit you is, okay, I'm going to turn around and dispose of the shares. So any disposal of the shares that you now own will trigger a chargeable event for capital gains tax, and this is where this carrying value comes back into play. Okay, so the capital gain previously held over now needs to be accounted for. So in our example, I said the base cost for any future disposal was 0. Okay, so whatever you sell them for today, you're going to pay tax on that whole amount that you get for the shares. So meaning the full amount we receive for shares is taxable at 20%, which is the personal capital gains tax rate for the sale of shares as it stands today, for a higher rate taxpayer. So again, I've got a quick example of that. He says, so numbers, similar numbers again. So we've got 5 HMOs today worth 750 that have increased in value from 450. So this is just again showing you exactly what the net value of the company is. So you sold the properties, you paid back the mortgage, you take off the corporation tax liability, leaves you with that amount of net proceeds. So that's a summary of the last slide. You're then selling the shares. So the shares that are worth the cash in the company. The carrying value, which is you have to take into account the capital gain that you rolled into the shares. So you are going to pay tax on all 1.995 million of those of that share disposal, 20%. So nearly £400,000. So you're going to come out with nearly £1.6 million doing it that way. Okay, so I mean this is for you to take away, have a look at. If you can follow how I've generated the numbers, you can do this for yourselves. Inheritance tax. So if you don't dispose of the shares during your lifetime, something will happen to them upon your death. Okay, so you have a nil rate band. This is a very simplified view of inheritance tax. You have a nil rate band. Each person has a nil rate band of 325,000, which is the amount of estate that you could give to anyone and not have to pay inheritance tax on. I'm going to ignore the residential nil rate band because it just turns around and confuses things. And the current rate of IHT is 40%. And because we are not, and as Chris alluded to earlier, we are not a trading business, so there are no reliefs. If you own a trading business, there is a business relief that you can claim, which will turn around and be free of inheritance tax. There are some things I'll go through a little bit later if I get a chance. So really, for inheritance tax, it's a lifetime piece of work to negate your inheritance tax bill, unless you want to get and survive for 7 years, but then you've got nothing to live on. So again, if you do nothing, your executors are going to be faced with selling all the properties, and this again comes down to, well, what is it that you might want to hand on to your beneficiaries? Okay, if you are wanting to hand on and sort of an intact property portfolio, you have either got to have some other cash in your estate or other assets in your estate that are going to pay the IHT bill. Otherwise, they are going to have to sell all the properties to be able to extract the money tax efficiently out of the company to pay the IHT bill, because if they sell them piecemeal, they're going to end up paying an awful lot more tax. So, I've got an example, I'll show you in a second. So, but what it says here, the properties will need to be sold, you've got to pay corporation tax on the gain, and then it's that same issue, it's stuck in the company. So the estate's got to put it out, and pay some tax, to then pay the inheritance tax bill. Whereas if you turn around and sold all the companies, sold all the properties, liquidated the company, there is a few criteria that you need to hit. You can distribute that out to the estate, and that won't incur a further tax charge, and then you've got the funds intact to pay the inheritance tax. I've got an example of that. So,
sorry, John, just on that, this morning you said that you wouldn't pay...
I didn't say that, but Paul said that.
You wouldn't pay corporation tax,
Yeah.
dividend tax,
Yeah.
and inheritance tax if you're dead.
If you sell piecemeal, you will. If you sell the whole portfolio, you won't. So there was a number of Paul spoke about it briefly after. There was a number of questions flying around at the time, and one person was saying, so if I liquidate all the company, will I turn around and have to pay 3 layers of tax? And the answer is no, you won't. And if you sell it piecemeal, because Parliament said if I sell it piecemeal, and I said to him, yes, you will. Yeah, so if you sold a lot, it's more tax efficient. If you do it piecemeal, you will have 3 layers of tax.
Okay.
So, same example, yeah. Net value of the company, we've seen that number before, yeah, 1.995. Shares are CGT exempt on death. Okay, so there's no cap. So if you die, there's no capital gains tax to pay. It dies with you. So that gain that you kick down the road dies with you. Fantastic, isn't it? Wonderful. But you've got a bigger issue. Yeah, you've got a 40% tax bill, whereas the tax bill on your shares would be 20%. So as much as it sounds lovely that you've just negated the gain, your estate, and it is your estate, so your argument might be, it's not me. Yeah, I'm not paying the capital gains tax bill on my lifetime, my children are potentially paying it upon my death. So there is a bigger issue that you've got to deal with, which is an £800,000 IHT bill. And again, this is assuming you've used up all the various reliefs that are available, you know, your main home.
How long would you have to pay back to HMRC? Is it wanted immediately or?
Well, because it's shares, it's immediate. So if you own the properties personally, you've actually got 10 years. So if a lot of the assets in your personal estate were properties, HMRC will give you a time period. Might not be 10 years, sorry, but you have a time period to turn around and pay that. Because it's shares, it's immediate. So they are going to have to do something to turn around and get this sorted. Brings in a bigger discussion. What else do you have in your estate? Is there something else that could pay the bill? And that's part of your bigger, wider lifetime planning type scenario.
When you say immediate, what do you mean by
You won't get probate and you can't start dealing with stuff until you've paid the inheritance tax. They're not. Now, what's the actual statutory time period, Chris? Is it?
Sorry.
For payment of an inheritance tax bill on an estate? Is it? Yeah, I was going to say I think it's 6 months. I didn't want to quote 6 months and Chris tell me I was wrong, but I think it's... So, again, you are either going to have to liquidate the lot. Now, that might not sit well with you because you might want to pass these on they're cash machines, yeah? Or you're going to have to turn around and sell them piecemeal. This is the example Harry turns around and tells you why there's a difference. So, you've got IHT to pay of 800 grand, 1.995 proceeds, yeah? Upon liquidation, there's no further tax to pay. Yeah, so you take the 199, you liquidate the company, there is obviously liquidation costs and what have you. You pay the IHT bill, you've got £1.2 million pretty much of net proceeds, okay? And as I say, this is not taking into account liquidation costs. There's a few things that you need to, when you liquidate a company, you're distributing the money as a capital distribution, and there's a few qualification criteria that you need to hit. Not too onerous, he says. So you either sell it all or you just sell some. Now, selling some sounds really good, but the issue that you then have is you've most probably got to sell more than you think because you're going to have another layer of tax to pay. So in this example, same again, you've got your 5 HMOs. I just literally took 3 because you've got to either sell 3 or you have to sell a whole property. So when you'll see, there's a slight minus figure coming up. So that's 3 or 4. If you want to totally cover the inheritance tax bill, you've got to sell 4 out of 5. If you had 50 grand elsewhere, you could sell 3. So you sell 3 at 750. So that's 2.25 worth of income coming in. You turn around and settle. There's the corporation tax bill on 3. So you've got 153 grand's worth of corporation tax to pay. You've then got to settle the mortgage, pay the corporation tax. You've got the 1.2 million pounds worth of proceeds, and you think, oh, well, that's great, I'll just extract that and pay the IHT bill. But you can't, because you've got to turn around and pay some dividend tax to get it out of £700,000. Yeah? So then all of a sudden you don't actually have enough to turn around and pay the IHT bill, so you're going to end up having to sell 4 if you need to pay it all. Alright, so again, the bigger picture, the whole lifetime plan, what is it that you want to pass on? And if you're thinking, I want to pass on the property portfolio intact, well then you might want to be thinking of insurance policies or other things that are going to give, or the main home or whatever it is is going to give your beneficiaries the money to pay the tax bill so they don't have to be liquidating the properties, maybe. So some things here. So
just a quick question on that. Can the life insurance be paid by the company?
yes, there is a relevant life policy. And it goes to 75 though, Paul, that's the only thing. Relevant life is something I hear all the time. People bang on about it. Get relevant life, it'd be great. It's a great IHT thing. Yeah, if you die before 75. I hopefully am planning on not, so therefore it's a useless inheritance tax planning tool because you can't get relevant life post 75. But there are some insurances that you could potentially take out, and relevant life may have a part to play in that. So again, one of the things that you could do with it being in a company is, okay, well, you can turn around and transfer shares over time by bringing in family members. Like I say, it could take some time to turn around and transfer all the shares to family members. You can start gifting shares, and it could make the inheritance tax situation look somewhat better. Again, there are, if you're going to gift more than the capital gains tax allowance on an annual basis, there is some tax to pay. But this is, again, it's a calculation that we would weigh up. Yeah, you might be better off paying some little bits of tax year on year and gradually be getting it out of your estate so that you're not hit with a big 40% tax bill at the end. There are some good ways of actually gifting shares to trust, and once again, rolling over the gain. Right? So there are some instances where you've already rolled the gain over from personal ownership to incorporation. The gain is then in the shares. There are some ways of then gifting those shares to trust. Yeah, there are limits and what have you, but you can give some of those shares to trust, and you can roll the gain again into the trust. Yeah, and it's then when the trust sell the shares that the gain would need to be payable. So you're constantly kicking the can down the road even further and even further. Okay, so but that obviously needs quite a lot of planning and looking at whether that would be relevant and right for you. Can be, this could be a good way of providing income to other family members, kids going to university, what have you. So you might be able to, if you've got kids at university and you give them some shares and they start taking dividends that can pay for some of their living costs. You can't just gift shares to minor children and then start paying them money, because if they're minor children, the money that you pay them is actually taken as yours and put on your tax return. But there's, as I say, there's some bits and pieces there. I'm a bit short for time, which is why I'm trying to rush through. It could be a good way of getting family members involved to take an active part of running the company. You can gradually start, ceding control to children and grandchildren. If I'm a long way off that, but it might be relevant for some people. Paul has mentioned the freezer shares, which is where you turn around and start restructuring the shares within the limited company, so you can turn around and any gains from a set date onwards can be in some particular shares that you created. And again, the use of trusts can come into play here. Right? So these are all things, once you've got shares, there's a myriad of things that you can do. And it's whatever will be right for you and your personal set of circumstances. And one of the other things, you could just turn around and cash the company. You could cash the properties out, have all the money sitting in the company. Well, you could then use that money in the company to become a trading business. Yeah, and if you had the appetite to create a business that qualifies as a trade, you could then start claiming some inheritance tax reliefs later on. Okay, so that is that could be a very good way of turning around and using the property vehicle for a period of time to build up money, sell it all off, pay the corporation tax, leave it in the company, and then go and set a trade business up. You'd have quite a lot of cash sitting in a bank account, so you'd have to be very clever and smart how you did it. You may well be able to turn that into a trading business and start getting some inheritance tax relief.
Property trading company?
Potentially, flipping in theory is a trade. But there's a number of things that you could do, but you'd really want to be getting some very good advice at that point, because this is an area where HMRC would be live.
Different SIP code though, isn't it?
It is. So I'm saying that look at the use of business relief later on if you use those proceeds to do something else. So for me, there is, hopefully after today you'll have a clearer picture of some of the things that are going to hit you. Well, the old Stephen, you begin with the end in mind. me and Paul have done some work, and we actually do an incorporation report which covers and does all these calculations for you and gives you a really good idea of your own personal situation, and then Paul does a sort of a handhold service of helping you incorporate these on tap when the mortgage brokers kick in, when the legals kick in and everything else. So I'll whiz through this slide. And really for me, it's keep calm, but it is the bigger picture that is key. I think we're all somewhat focused on this more tax to pay. There are a myriad of solutions, of which incorporation is one major one, and Chris is going to cover some bits and pieces, I think, in his case study, which is some of the things he's done for a client or two that hasn't necessarily involved incorporation. All right, but hopefully that's giving you a flavour of what the tax landscape looks like and when these taxes are going to come and hit you at different times. All right, and then we've got questions we'll put back to, we've got a slot later, haven't we?
Yeah, we have.
Great. Thank you, chaps.